Learning Module, Portfolio Risk and Return, Part 2. Topic: Capital Asset Pricing Model, Applications. An analyst is least likely to use the expected return from the CAPM to directly. A. Judge whether a stock is undervalued by comparing it to the analyst's own return estimate. B. Compute the ex-post Sharpe ratio of a managed portfolio. C. Establish a benchmark return for performance evaluation of an active fund manager. CAPM provides a forward-looking expected or required return. The ex-post Sharpe ratio is a historical performance measure using realized returns. CAPM expected return is not an input into Sharpe ratio calculation. A. Comparing CAPM required return to analyst's own estimate is a primary application for judging undervalued or overvalued stocks. C. Using CAPM to establish a benchmark return for performance evaluation, such as Jensen's alpha, is a common application. CAPM output is a hurdle rate for forward-looking decisions. Sharpe ratio uses historical realized returns. The question asks for what CAPM is least likely used for directly. Topic: Portfolio Performance Appraisal Measures. An analyst is evaluating 3 mutual funds and gathers the following annualized data. Fund X, mean return equals 16.2%, standard deviation equals 22.0%. Fund Y, mean return equals 11.5%, standard deviation equals 14.8%. Fund Z, mean return equals 13.9%, standard deviation equals 18.1%. If the annual risk-free rate is 3.0%, which fund has the best risk-adjusted performance based on the Sharpe ratio? A. Fund X. B. Fund Y. C. Fund Z. An analyst wants to assess whether a fund manager has generated returns above what is justified by the fund's exposure to market risk, as defined by the CAPM. Which measure should the analyst use? A. M to the power of 2. B. Jensen's alpha. C. Sharpe ratio. An investor wants to know if a mutual fund generated excess returns beyond what its market risk exposure justifies, and wishes to interpret the result without comparing it to other funds. Which measure should the investor use? A. Treynor ratio. B. Jensen's alpha. C. Sharpe ratio. Which performance measure is most suitable when evaluating a portfolio that still contains significant non-systematic risk? A. Treynor ratio. B. Jensen's alpha. C. M to the power of 2. Which pair of performance measures is most appropriate for evaluating a well-diversified portfolio where only systematic risk matters? A. Sharpe ratio and M to the power of 2. B. Treynor ratio and Jensen's alpha. C. Sharpe ratio and Treynor ratio. When evaluating the performance of a specific fund that forms part of a well-diversified investor's portfolio, the performance measure that adjusts returns for the fund's contribution to the portfolio's overall market-related risk is the A. Sharpe ratio. B. M squared. C. Treynor ratio. An analyst collects the following data on 3 diversified equity portfolios. Portfolio X, mean return equals 10.5%, beta equals 1.1. Portfolio Y, mean return equals 14.2%, beta equals 1.8. Portfolio Z, mean return equals 12.0%, beta equals 1.0. The risk-free rate is 2.0%. The portfolio with the highest Treynor ratio is A. Portfolio X, B. Portfolio Y, C. Portfolio Z. A portfolio earned a return of 15.0% last year. Its beta is 1.2. The market return was 10.0%, and the risk-free rate was 3.0%. Jensen's alpha for the portfolio is closest to A. 1.20%, B. 2.40%, C. 3.60%. In a regression of a fund's excess returns on the market's excess returns, what does the intercept represent? A. The fund's beta. B. The fund's Sharpe ratio. C. Jensen's alpha. Sharpe ratio equals mean return minus RF divided by standard deviation. Fund Z has the highest Sharpe ratio, 0.602, meaning best risk-adjusted performance. Raw returns alone ignore risk. Sharpe ratio measures excess return per unit of total risk, standard deviation. Do not select based on highest return, X at 16.2% or lowest risk, Y at 14.8% alone. Sharpe ratio is the slope of the CAL. Higher ratio equals steeper slope equals better risk-return trade-off. Appropriate when evaluating portfolios with total risk, not fully diversified. Jensen's alpha directly measures excess return relative to CAPM's required return. It isolates performance based on systematic risk, beta, consistent with CAPM. A. M to the power of 2 is based on Sharpe ratio and total risk, standard deviation, not systematic risk, so not tied to CAPM. C. Sharpe ratio uses total risk, standard deviation, while CAPM focuses only on systematic risk, so not consistent with CAPM. Jensen's alpha equals systematic risk focus, CAPM. Sharpe ratio and M to the power of 2 equals total risk focus. The question asks for CAPM consistent measure. Jensen's alpha provides an absolute measure. Alpha equals actual return minus CAPM required return. Positive alpha equals beat benchmark, negative alpha equals underperformed. The sign alone is interpretable without comparison. A. Treynor ratio uses beta, but produces a relative score, for example 0.08. It requires comparison to market or other funds to interpret, cannot be used alone. C. Sharpe ratio uses total risk, not market risk specified, and also produces a relative score requiring comparison. Jensen's alpha equals absolute excess return, in percentage, sign interpretable alone. Treynor and Sharpe equals relative efficiency ratios requiring benchmarks. The question specifies both market risk exposure and without comparing. M to the power of 2 is derived from Sharpe ratio and uses total risk, standard deviation, which includes both systematic and non-systematic risk. Suitable when non-systematic risk is still present. A. Treynor ratio uses systematic risk only, beta. Assumes portfolio is fully diversified, not suitable when non-systematic risk remains. B. Jensen's alpha also relies on beta, systematic risk, assuming diversification, not appropriate for portfolios with significant non-systematic risk. Total risk measures, Sharpe ratio, M to the power of 2, equals appropriate for non-diversified portfolios. Systematic risk measures, Treynor, Jensen's, equals appropriate only for diversified portfolios. The question specifies significant non-systematic risk. Well-diversified portfolio equals only systematic risk remains. Treynor ratio and Jensen's alpha both use beta, systematic risk, the only relevant risk. Most appropriate and precise. A. Sharpe ratio and M to the power of 2 use total risk, standard deviation, which includes non-systematic risk, that shouldn't exist in a well-diversified portfolio. Misleading and penalizes incorrectly. C. Mixed pair, Treynor plus Sharpe inconsistent, blends systematic and total risk frameworks. When only systematic risk matters, both measures should use beta. Systematic risk measures, such as Treynor, Jensen's, are for diversified portfolios or components. Total risk measures, such as Sharpe, M to the power of 2, are for overall investor portfolios, may not be diversified. The question specifies well-diversified and only systematic risk matters. Investor's portfolio is well-diversified, only systematic risk matters. Fund's contribution to this risk is measured by beta. Treynor ratio, excess return divided by beta, directly measures return per unit of systematic risk added. And Sharpe ratio uses total risk, standard deviation, which includes non-systematic risk irrelevant to a diversified investor. Would penalize reward the fund for risk that doesn't affect the portfolio. B. M to the power of 2 is derived from Sharpe ratio, also uses total risk, standard deviation. Not appropriate for component of diversified portfolio. For portfolio components in diversified context, use beta-based measures such as Treynor, Jensen's. For total portfolio, possibly undiversified, use total risk measures such as Sharpe, M to the power of 2. Question specifies fund that forms part of a well-diversified investor's portfolio. Treynor ratio equals mean return minus RF divided by beta. Portfolio Z has the highest. Portfolio Y has highest raw return, 14.2%, but lowest Treynor ratio, due to high beta, 1.8. Portfolio Z wins because it has high excess return, 10.0%, with lowest beta, 1.0. Higher return doesn't guarantee higher Treynor ratio if beta is proportionally higher. Jensen's alpha equals portfolio return minus RF plus beta times RM minus RF equals 3.6%. Jensen's alpha measures outperformance relative to CAPM benchmark. Positive alpha, 3.6%, means portfolio beat its required return, given its systematic risk beta 1.2. The intercept alpha is Jensen's alpha, the abnormal return beyond CAPM expectations. A. Beta is the slope of the regression line, not the intercept. It measures systematic risk. B. Sharpe ratio is a separate performance measure using total risk, not derived from regression intercepts. Intercept equals alpha equals actual return minus CAPM expected return. Slope equals beta. The regression explicitly separates these components. Topic: Applications of the CAPM in portfolio construction. The slope of the line obtained from regressing an asset's returns on market returns is best described as the assets. A. Non-systematic risk component. B. Beta. C. Jensen's alpha. Assume the risk-free rate is 2%, the expected market return is 9%, and a stock has a beta of 1.4. If an analyst estimates the stock's expected return to be 10%, she should conclude the stock is A. Undervalued because 2% plus, 1.4 times, 9% minus 2%, greater than 10%. B. Overvalued because 10% less than 2% plus, 1.4 times, 9% minus 2%. C. Properly valued because 10% equals 2% plus, 1.4 times, 9% minus 2%. An analyst gathers the following data. Risk-free rate 2.0%. expected market return 10.0%. 3 stocks have the following characteristics. Stock X, expected return equals 15.2%, beta equals 1.8. Stock Y, expected return equals 11.8%, beta equals 1.3. Stock Z, expected return equals 9.5%, beta equals 0.9. According to the CAPM and SML, which stock is most likely overvalued? A. Stock X, B. Stock Y, C. Stock Z. A portfolio manager using the CAPM for security selection calculates Jensen's alpha for 3 potential investments. To maximize the portfolio's risk-adjusted performance, the manager should: A. Avoid all securities with a positive alpha to prevent overconcentration. B. Allocate the most capital to the security with the largest positive alpha. C. Give equal weight to securities with positive alpha regardless of its magnitude. When building a large, diversified equity portfolio, a manager should prefer securities that have: A. High total variance but low beta. B. High non-systematic variance and high alpha. C. Low non-systematic variance for a given level of systematic risk. The following table shows data for the stock of Apex Corp and a market index. Expected return of Apex Corp 14.5%. Expected return of market index 11%. Risk-free rate 4%. Standard deviation of Apex Corp returns 25%. Standard deviation of market index returns 20%. Correlation of Apex Corp and market index returns 0.70. Based on the capital asset pricing model, CAPM, Apex Corp is most likely: A. Overvalued, B. Fairly valued, C. Undervalued. An analyst calculates the required return for a stock using the CAPM to be 8.5%. Her own valuation model, based on discounted cash flows, implies an expected return of 11.2%. Based on this information, the stock is most likely: A. Overvalued, B. Fairly valued, C. Undervalued. Market model regression. Asset return equals asset alpha plus asset beta multiplied by market return plus asset error term. The slope coefficient, asset beta, is the asset's beta, measuring sensitivity to market returns, systematic risk. A. Non-systematic risk is captured by the residual term or asset error term, not the slope. Slope equals systematic risk, or beta. C. Jensen's alpha is the intercept, or asset alpha, in excess return regression, not the slope. Regression slope equals beta, systematic risk. Intercept equals alpha, abnormal return. Residual equals non-systematic risk. The question asks specifically about the slope. CAPM required return equals 11.8%. Analyst's estimate equals 10%. Since 10% less than 11.8%, the stock is overvalued, its expected return is below what CAPM requires for its risk level. Undervalued equals estimated return higher than CAPM return. Properly valued equals estimated return equals CAPM return. Neither applies here. Overvalued equals estimated return less than CAPM required return. The difference, alpha, is negative, indicating overvaluation. Investors are not adequately compensated for the risk. Overvalued equals expected return less than CAPM required return. Compared to expected returns. X, 15.2% less than 16.4% equals overvalued. Y, 11.8% less than 12.4% equals overvalued. Z, 9.5% greater than 9.2% equals undervalued. Both X and Y are overvalued, but the question asks most likely overvalued. Stock X has the larger shortfall, 1.2% versus 0.6%, making it more significantly overvalued. Jensen's alpha measures abnormal return beyond CAPM expectations. Larger positive alpha equals greater excess return per unit of systematic risk. To maximize risk-adjusted performance, allocate most capital to security with largest positive alpha. And avoiding positive alpha securities rejects excess return opportunities, reduces portfolio efficiency. C. Equal weighting dilutes the benefit. Not all positive alphas are equal. 3% alpha more attractive than 1%. Alpha greater than 0 equals undervalued or superior, allocate more. Alpha equals 0 equals fairly valued, neutral. Alpha less than 0 equals overvalued, avoid. Magnitude matters. In a large, diversified portfolio, non-systematic risk is eliminated. Managers prefer securities with low non-systematic variance for a given level of systematic risk. They contribute less unnecessary, diversifiable risk while maintaining desired market exposure. A. High total variance may come from large non-systematic component, even with low beta. Undesirable as it adds risk that diversification will eliminate, but still affects security selection. B. High alpha is attractive, but high non-systematic variance adds from specific risk that reduces portfolio efficiency. Alpha doesn't compensate for excessive diversifiable risk. Example, same beta, same systematic risk, lower non-systematic variance equals preferred. The goal is to minimize diversifiable risk for chosen systematic risk level. Beta equals 0.875. CAPM required return equals 10.125%. Actual expected return 14.5%, greater than CAPM required return 10.125%, undervalued. Undervalued equals actual return greater than CAPM return. Overvalued equals actual less than CAPM. Fairly valued equals actual equals CAPM. Apex meets undervalued condition. Valuation status determined solely by comparing actual expected return to CAPM required return. Beta calculation is necessary first step. CAPM required return equals 8.5%. Analysts' DCF expected return equals 11.2%. Since 11.2% more than 8.5%, the stock is undervalued. Investors receive more return than required for its risk level. A. Overvalued would require expected return less than CAPM return, opposite of given. B. Fairly valued would require expected return equals CAPM return. Not the case. Valuation rule. Expected return greater CAPM return equals undervalued. Expected return equals CAPM return equals fairly valued. Expected return less CAPM return equals overvalued. Simple comparison determines status.